Hi, you guys. I'm Phil Town from Rule Number One Investing, and today I'm going to test your investing knowledge a little bit. So how well do you know real investing? Millions of Americans just like you have their retirements invested in 401ks, which are crossing with mutual funds and indexes funds, or they're directly investing in index funds and IRAs, and the money's in the stock market. But understanding how the stock market actually works, that's a whole different story. Most people who are investing don't have a clue. They're just putting the money in and hoping for the best because that's what the financial advisors tell them what to do, right? So let's see how you do with this quiz. Some of these answers, I think, just might surprise you, particularly if you're paying attention to what most advisors are going to tell you. So if you think you know investing or you want to learn some truths about how this actually works, follow along with this video and make sure you leave how many questions you got right in the comments below, and be honest. All right, first question, true or false? The stock market always goes up in the long run. Okay, so this is true. And while it's true also that inflation will ultimately drive the stock market up, there have been decades in which it continued to be suppressed. If you're concerned with the day-to-day rises and falls of the market, you might not realize that in the long run, the stock market does go up. But then as George Soros says, in the long run, we're all dead. So how long can the long run be before the stock market gets back above its previous high? You're going to get shocked at this. And from 1905 to 1922, the stock market didn't go above its previous high. It's almost 20 years. Then it took off, all right? Then if you'd invested in 1929, right at the peak, you didn't get your money back for 26 years. Broke even in 1955. And if you invested right at the peak of the market in 1965, you didn't get above that, and it took you, ready for this, 19 years to break even. Finally broke even in 1984. So we go through these long periods of time. 10 years is not uncommon. No matter what other people tell you, take a look at the long-term stock market and you'll see it's true. Stock market always goes up, but then again, how long do you got? All right, next question, true or false? Those people who beat the market in the long run only do so because they've either studied hard or have above average IQs. In other words, they're really smart. True or false? So this one is false. Most financial professionals or the so-called experts, yeah, they might be smarter than us. They might be the valedictorian of their class and they got to Harvard. All right, they're smart people. But guess what? They remove their ability to beat the market by following modern portfolio theory, which says massively diversify and hold. And by the way, you can't beat the market. And what that means is they're basically just going to match the growth of the market itself. Any idiot can do that. Just go out and buy SPY and you've solved the problem that these geniuses are trying to do. And by the way, you're paying them for all that. In fact, most of the time, financial professionals don't even try to outperform the market. All they're trying to do is just kind of stay with it. And what that means is that literally anyone can invest. If you'll learn a simple set of rules and repeat them, you can invest and probably do better than the experts, no matter how much smarter than us they are. Most rule number one, Warren Buffett type investors can reach out for returns of 12 to 15% per year. And if you can do that, you will crush the market. You don't have to be a genius to do it. Buffett himself, he's a genius and he's averaging about 20% a year, but he's doing it with billions of dollars. A few years ago, Warren went to Columbia University and showed the university a large group of investors with publicly audited accounts that had smashed the stock market. And the rates of return ranged from about 18% to 34% a year, and Buffett was in the middle of the pile. Now, he's saying over and over again that it isn't intelligence. That's not the critical thing. He's saying that a person of 160 IQ isn't going to be doing better than somebody with a normal IQ. A person with a normal IQ and the ability to be patient and to follow a few simple rules of investing can absolutely outperform the professionals, no matter how smart they are. All right, next question. Real estate does not need to be part of everyone's portfolio. Okay, so this one is true. Many people think that real estate is the way to go if you want to get a guaranteed return on your investment. But here's the thing, the real estate market is volatile and it's controlled by a lot of external factors. While individual real estate investments might outperform the market, they really got to be in the right market. They got to be at the right time. And often they take a lot of effort to find them and a lot of time to make them better. So think about all the time that goes into real estate. What if you could make the same amount of returns or more from investing in the stock market? Do you really need real estate to be part of your portfolio? Particularly when you take a look at what great investors like Buffett, the rulers that we talk about all the time here on this, what they're capable of doing. I took a look at Toronto real estate. I just did a speech up there not too long ago. And Toronto real estate grew at about 4.8% per year, ballpark, something like that, over the last about 50 years. And if you put in, let me see, about $10,000, your $10,000 would have grown to almost $1 million. So real estate did pretty darn well up in Toronto, okay? Now, do the same thing, but with the stock market. You just put it into an index fund, as all of your advisors tell you to do, sit on it for the next 54 years, and that would have turned into ballpark $3 million. So you would have made quite a lot more money, even though the rate of return is only slightly larger. Now, instead of that, do what I'm urging you to consider, and that is to learn to invest and follow the teachings of guys like Warren Buffett and Charlie Munger, and you may do as well as them, which means about a 24% return, and that produced $10,000 into something like 40 million. It was just insanely bigger. So do you need real estate? No. Is it a good model for buying companies? I like it. I think it's a great model for buying companies. Buy companies the way you buy real estate. You probably do pretty good if you buy real estate well. All right, next question. True or false? Risk and reward in the stock market are absolutely related. If you want a higher return, you gotta be willing to take more risk. This is screamingly false. Oh man, I hate this thing. It's so commonly thought to be true. Your advisors probably think it's true. The securities regulators all think it's true. And it's what's taught is true in most academic settings. Most Ivy League universities, risk and reward are related. You can't get a high return without taking a high risk. It's totally not true. And unfortunately, so many people believe it, but it is a myth. If you're doing it right, if you're investing right, you're not taking risk with your money. You're buying really valuable businesses, but you're buying them on sale. That's the whole concept of margin of safety is about. I mean, don't you like it when you can buy your favorite pair of jeans on sale? And the same thing's true with investing. True investing is all about reducing your risk by knowing what you're doing and then purchasing this thing that has a high value at a low price. You think about how in the world could it be riskier to buy something worth $100 by paying $50 than paying $100? Which one's riskier? Pay $100 for $100 of value or pay $50 for $100 of value? And how would it get riskier if the price went to $20? So by researching businesses and understanding the financials, you should be able to choose a few excellent businesses. And then to further reduce risk, you just wait until you can buy that wonderful business when it's priced at half off its value. And you guys, the thing that's amazing about the stock market that they don't tell you is that it fluctuates regularly. Every 5 to 10 years, the stock market goes through a big fluctuation. And when that happens, all those wonderful companies are going to go on sale and you can buy them. So learn to do it, learn to be patient, and guess what? The returns can be enormous with lower risk than putting your money in a mutual fund. All right, next question. True or false? The best way to offset the risk of investing in the stock market is to diversify across a large number of stocks. Oh man, so many people believe this is true. And it is true, sort of. If you don't know how to invest, then that will help you and that'll make it less risky. But for an investor, that means someone who knows what they're buying and is going to buy it when it's on sale. This is patently false. Over diversification, which is what everybody does, or buy some of everything, is just insurance for investors who don't know how to find the best investments. For someone who knows what they're doing, it's not helpful. It actually hurts your rates of return. So spreading out your investments across the whole market means that if the market plunges, so will your whole portfolio. It's all going down. The best way to offset risk then is to buy businesses that are priced well below their value, businesses that you understand. And because of this strategy, Rule 1 investing can be done in any market. Doesn't matter if the stock market is sky high or super cheap, and you can still get great returns, as opposed to diversification that merely reflects the broader market activity and goes through those fluctuations. So we want to avoid over-diversification unless we are ignorant. If you're ignorant, let's change that, okay? Let's make you a great investor. Okay, true or false? A broad market mutual fund is the best choice for a low-risk retirement account like a 401k or an IRA. Oh man, they sure try to sell you on this idea, don't you? I mean, it's like they're making money on those big broad market mutual funds. Is that really the best place to put your money, in an IRA and a 401k? We think that's false. With Rule 1 investing, your age or stage of life doesn't really matter that much. Risk is managed by our strategy to invest in wonderful businesses when they're on sale. Rule 1 investors have no interest in most mutual funds, which tend to spread out their investments way too thin. We want to invest in a small number of things we really understand, and we want to get a great return for it. Okay, last question. True or false? Almost no one beats the market in the long run. So this is just totally false, and you know that if you've been watching these videos at all. We truly know that Rule 1 investors are consistently beating the market. They've been doing so for 90 years, starting with Ben Graham and going all the way through this amazing family of investors straight up to today. And for you, you can go out, learn a little bit about this, and get 15% per year or greater returns. You can beat other investors and do it with very little time. It's just a matter of learning how, you guys. That's what we want to teach you. So we'd love to hear from you. How did you do on the quiz? Did you do pretty well, or did you, fall into the efficient market theory trap and answer them all wrong? All right, let me know in your comments. And thanks for watching. Now go play. You guys, if you enjoyed this video, you feel it was valuable in teaching you some great investing facts as opposed to the myths, hit the like button and please share this video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen for a free gift. And thanks again for watching.